Here are the current federal tax developments for the week of July 27th, 2026. I'm Ed Zollars, and this week we're looking at a number of developments taking place in taxes that have occurred over this week, plus an update from the AICPA that will affect you if you are in tax practice, but you are in a CPA firm that does a test work. So we'll talk about that one as well. So we're going to begin this week looking at the case of Lewis versus Commissioner, Tax Court Decision 2026-58. And this particular case are consolidated cases from Linda M. Lewis and Peter F. McDougall. Now, this involves the children's surrender of a remainder interest in their parents, in their living parents, shall we say, trust that was that was formed and had essentially a Q-tip value, a Q-tip structure. And it was taken care of in this particular change that the kids essentially, they wanted to redo the trust. And so because of that, the kids decided to, in a restructuring, give up their rights in this trust and allow dad to move the money and move the base of the assets to a trust that essentially he had the right to revoke. So this is kind of our background. So this is from the termination prematurely of Clotilde McDougall's, I should say, residual trust. And the fair market value of trust assets that were stipulated by both sides was $117,604.143. The trust was commuted via a non-judicial agreement on October 31st, 2016. All assets were distributed outright and free of trust to Bruce McDougall, right? Effectively. Now, in the prior ruling, McDougall versus Commissioner 163 TC 112, this held that the children had made taxable gifts but didn't go on to the value of them. And this is important to understand. If you restructure something like this, let's say like a Q-tip trust, where the kids had basically the surviving spouse, in this case, I believe it was dad. Dad has the right to, the income from the trust for life, or mom, whoever the survivor is. But at that person's death, the trust assets go to the kids. It is a structure, and quite often, it was a Q-tip trust structure used quite often because we wanted to make sure the assets got included in the surviving parent's death. Now, for various reasons, we may later decide that we don't like that structure. A lot of times a surviving spouse will chafe under that structure, not be happy because essentially he or she feels that it's they have to beg their kids for money, and their kids may be questioning as to whether or not the income has been computed right, whether maybe mom's taking too much money, all of those issues. So for various reasons, because of various odd concerns, we may decide just to, it doesn't matter anymore. We're not concerned about this anymore. So we may decide to want to try to get rid of that trust. Now, there are other issues with getting rid of that trust. And we're not going to talk about the legal. We're just talking about the tax aspects here. I'm not suggesting that you just go terminate these things without getting a lot of legal guidance ahead of time. Because turns out that if you disinherit a kid and they couldn't have been disinherited had it not come out of that trust, there might be some non-tax problems too that will come up. We'll get there. But as I say, the court said this is a taxable gift. The children surrendered valuable remainder interest. They received nothing in return. And that would be true whether they actually just distribute it to, let's say, mom or dad, the assets, or if we put it into, just made the trust so that mom and dad could modify it. Well, you gave up a guaranteed right to the residual, or at least a quasi-guaranteed right to the residual. There were certain rights you gave up. So the gifts would equal the value of the terminating distributions the children would have received under the will, but we got to figure out what that value is. They are definitely gratuitous transfers. They met the requirements of Section 2501 and 2511. So the McDougall case, 163 TC 112, held, guys, it's a gift. They're giving up something of value. They're giving it up, for basically for nothing in return. It's a gratuitous transfer. They're willing to do it. This is like, textbook gift. don't tell me there's no gift. But there's still a question as to what exactly is this involved. And in this case, the IRS was going to try to use the actuarial tables to value this, just present value of the assets using the actuarial tables for what would go to each kid. And the court said no, that's not how this particular situation should be done. What happened here, the trustee under the trust for income and principal was required to distribute net income to Bruce at least annually. Discretionary principal distributions were authorized only for health, maintenance, and support. And the support standard was tied to Bruce's accustomed manner of living. Bruce is dad, the surviving spouse. Now, Bruce also had a power of appointment. He held testimony limited power to appoint principal among descendants. In default of appointment, the remainder would be divided into equal shares for living children. And a spendthrift clause was included in that trust that protected the trust assets. But we're going to get to section 12.8 of the trust, a mandate there, right? Upon termination, trustees must distribute assets among beneficiaries. These distributions did not have to be pro forma. Distributees must receive assets equal to the value of the respective interest. So this is, in theory, what we gave up. Question is, what's the value of that? And remember, the clause here is that it didn't have to be pro rata, and we just have to receive values. How do we determine those values, right? Now, on October 31st, Halloween 2016, the children and the father, Bruce, executed the non-judicial agreement. It provided that the trust is commuted and the entire remaining balance of over $117 million is distributed to Bruce. No reserve was established for the payment of transfer taxes. Bruce's personal representative had previously made, Bruce, as personal representative, I should say, had previously made a Q-tip election under 2056B7. So we are terminating a Q-tip trust. That's what's happening here. The question is, how do we measure the gift? The prior court order on April 25th, 2025 clarified the gift's measurement. The value of the gifts equal the terminating distribution the children would have been entitled to receive under their, under the spouses, their mothers. I presume it's in this case they're her kids, but well, whatever. In essence, under her will. Now, the taxpayers argue the nominal values of $156,000, or at most $34.9 million. Again, this is of the 117.6. The commissioner, using the discount factors from the actuarial tables, argued there was a taxable gift of $408,746. Get that right. For each of the child. So over $100 million of gifts that the children had at that time. So how does the court choose here, right? Now, the valuation centers on a discrepancy of, the 156,000 to the 53.4 million. Now, the taxpayers expert, David Eckstein, he said he used the undiscounted cash flow model. Scenario 1, the base, disregarded power of appointment and principal rights and valued that at 36.6 million net. Under the secondary scenario, he assumed that Bruce would exercise his discretionary principal right was assumed, and that reduced the value of each child's interest to $34.9 million. Now, when he factored in the power of appointment, he included a nominal value of $156,000. Now, the commissioner's expert, David Fuller, he rejected a discounted cash flow model entirely. He supplied the subtraction method to value the remainder, subtracted the income interest from the trust net asset value, and he valued the remainder interest at just under $50 million pre-reimbursement. Now, the court ruled that the state law is going to override the 7520 tables in determining these property rights. Now, the commissioner argued that those 7520 tables are mandatory for remainder interest. But the tax court cited the case of Morgan v. Commissioner, 306 U.S. Supreme Court case, 30678. State law defines property rights, federal law taxes them. The power to transfer distribute trust assets is essentially local law. 7520's opening words, for purposes of this title, restricts its application to the title, 26 United States Code, otherwise known as I.R.C. Why the tables are not terminated, trustee dividing assets under Section 12.8 of the will determines rights under Washington law, not the tax code. If we terminated this, it wouldn't be a federal issue, it'd be a state issue as to what the kids would be paid. Therefore, rigid actuarial tables under Section 7520 do not dictate property entitlements upon termination in this case. The tax court held state law governs property entitlements upon trust termination. Now, next we move on to look at Section 2207A, net gift adjustments, to reduce the transfer tax value. Now, under the Q-tip rules, Bruce would have made a deemed gift under Section 2519A if the children received terminating distributions. Okay. He would have had a statutory right to recover those gift taxes from the children under 2207A subsection B. He avoided reimbursement obligation must reduce the children's gift. Commissioner argued this was too speculative because no tax was paid. Now, the tax court ruled that the gift must be reduced under the net gift framework. The pre-reimbursement value was divided by 1.4, 40% being the marginal gift tax rate. At the time, it would have applied to this. He rejected any downward age adjustments for Bruce's high income or health. Going down that thing, the IRS tried to argue, well, he had high income, etc., so we'd expect him to live longer, was one of the arguments that came here, to reduce the value. And the court said, nah, you're not allowed to do that. Because indirectly, the court is kind of saying, you know what, if Bruce was on his deathbed, taxpayers, you wouldn't be arguing that it's valid. It's like, in essence, in this case, we're going to ignore that because we didn't do a full, we didn't go through a full actuarial study to figure out, what exactly Bruce's true life expectancy was. So the commissioner was held to the concession they made. The final gift was set at $35,141,321 per child. That's going to be kind of the background that came up in this case. Okay, let's move on now out of that case, and let's move to Revenue Procedure 2026-26. This will set the 2027 indexing adjustments for items related to the premium tax credit, right? So this is basically the 27 numbers. We're getting them now for next year. Now, this guidance targets procedure requirements for the premium tax credit eligibility and tax liability under Section 36 Cap B of the Code. It's effective for all taxable years and plan years starting in calendar year 2027. Now, basically the core mechanisms, it provides indexing adjustments to the applicable percentage table under I.R.C. Section 36 Cap B, subsection B3AI. It's used to calculate an individual's premium tax credit under Section 36B. This is the various percentages of income that each individual is, basically required to be treated as paying. It says they're responsible for that. And it established the required contribution percentage under Section 36B, subsection C2, Cap C, I, double cap I, for plan years in 2027. These are the key changes. Now, this revenue procedure applies income growth and premium growth metrics, right? This is the legislative, the methodological basis for doing it. And we're going to be moving a shift from traditional per enrollee spending index down. Now, the IRS derives the authority from growth calculation methodologies specified in Section 4 of Revenue Procedure 2014-37. This calculation combines both premium growth and income growth factors. Now, historically, premium growth rates were tethered to a national per enrollee spending. This is based on figures published in the National Health Expenditure Account. But the calculations now, we're expanding the metrics. It incorporates a much broader index for individual market trends. The adjusted values reflect comprehensive growth metrics. Now, HHS, Health and Human Services rule, shifts premium growth measure to capture individual market. Now, the Health and Human Services Marketplace Integrity Rule is what the IRS is going to reference here. It was initiated by that HHS Marketplace Integrity and Affordability Rule. It was published in the Federal Register, 90 Federal Register, page 27,074. It was effective starting with the 26 benefit year. and they expanded the premium growth measure is going to be applied for 27 adjustments. So now we're under it. Under this new individual market metric and new revised framework, this growth measure captures individual market premiums, right? That's the background. It captures individual trends in addition to employer-sponsored insurance premiums. That's the big change. And Treasury and IRS applied this expanded measure alongside income growth projections. Now, there is a fail-safe provision that can bypass additional adjustments for 2027 plan years. Under I.R.C. Section 36 Cap B, subsection B3, Cap A, little I, Cap I, that's the full reference, it provides an adjustment layer to the Apple percentages. It's normally triggered when certain premium and income growth thresholds are crossed. But the IRS determined it was unnecessary for the 2027 plan year. There's also a Section 36 Cap B, subsection B3, Cap A, I, 3 I's, and this establishes a fail-safe exception that overrides the additional adjustment. The IRS determined that the fail-safe is what's active for this year. There's one or the other. This is the one for this year. It limits the adjustments to the base table and the standard required contribution. Right. So this is the finalized 2027 applicable premium percentage table. And these percentages are used by taxpayers to compute how much of their income is, deemed to be required to be provided by them, or up to this is required to be provided by them before they could get a premium tax credit. And the premium tax credit will be the difference between this part of their income, household income, and the second lowest cost senior plan in their area. So, we got the same type of weird little set of rules. So again, for 2027, we're going to start at 2.15% for those at less than 133% of the federal poverty level. When we go above 133% of the federal poverty level, but we are less than 200%, then, or less than 150%, then we're going to beginning at 3.23%. There's an immediate jump at 133% to 3.23, and then we ratably move up to 4.3. So the first layer stays flat at 2.15, but you get that dollar change at 133%, and you're going to get a jump, right? Basically, you're going to be required to provide 1.08% extra of your income at that level. And then it ratably goes up to 4.3. Once we get to 50%, now we're going to, again, start with 4.3, but that's going to ratably move up through 200% of the federal poverty level to 6.78%. If we have 200% but less than 250, now we're going to take that range, again, start at 6.78%, and we're going to start slowly moving that up until we get to 50% to 8.66%, ratably over that range. At 250% but less than 300, we're going to go from the 8.66 to what's going to be the top rate if you can qualify for a credit, 10.22%. And that 10.22% will apply if your percentage of income is 300%, but not more than 400% of the federal poverty level. You'll pay 10.22%. Okay, you go $1 over 400%. Remember, now under current law, your premium tax credit just went to zero. Now, it also impacts the affordability percentage for plan affordability. And under Section 36 Cap B, subsection C2, Cap C I, and Treasury Regulations 1.36 Cap B -2, parentheses C3 V Cap C, this is the rate at 10.22% becomes that rate as well. So it's used to determine if employer-sponsored coverage is affordable for the employee. If the employee's cost exceeds 10.22% of household income, the coverage is deemed unaffordable. And that gets the employee the ticket. If the employer offers coverage and they're not demanding more than 10.22% of income, and there are special regs on how the employer tests that, then the employee cannot get a credit for getting their coverage off the exchange. That's the mechanics of the Affordable Care Act when we go back to the original rule rather than the ones we had temporarily that arose during the pandemic and expired last year. Okay, next up, we've got another ERC case, but this was a little different. This is Maddow versus Commissioner, Tax Memorandum Decision 2026-60. Opinion was released on July 21st of 2026. Now, the issue here deals with something that I heard a lot of CPAs do and a lot of EAs do. Remember, your client basically, because of how it was handled during the pandemic, many of our clients, qualified retroactively for at least some quarters for the employee retention credit. Didn't qualify at the time they actually paid the wages, because remember, at that time, if you took the payroll protection, if you took the, basically the payroll protection loans, you weren't allowed to claim the ERC. At the end of 2020, they changed their mind and retroactively allowed you to claim them, which of course meant a whole lot of amended returns. As you might know, we all know the IRS got flooded with a ton of paper 941Xs because Congress, frankly, didn't think this one through. Congress can be rather short-sighted in trying to figure out how this is going to work. It's not their problem. They ignore the problem. That's the job of Congress, and Congress did that job very well in this case, creating a system that was bound to collapse from inception. And, well, actually, I blame Congress. You could say, well, yeah, but it's the staff. Well, yeah, but gang, the people we elect are the ones that hire the staff. They're the ones in charge of the staff. Like it or not, they are responsible. The buck stops with the Congress. Don't let your Congress critter get out of this one, right? Because it's amazing how it's never their fault. It's their fault they passed this law, period. Okay. Yep. End of rant for today. So, what happened, though, was obviously, remember, you had to reduce your wages claimed on the income tax return based on the ERC that you were qualified for payroll tax purposes. Now, if you got your credit on the 941 mechanically, because you did it as we went through each quarter, then that all matches up nice. But now these refunds are stacking, and people were confused about who qualified and who didn't. And we have a ton of cases on that taking place right now. Finally, we're litigating that one out. But what a lot of CPAs did, and a lot of EAs did, was they decided their client would apply for the ERC refund. However, or a mill got, basically a ERC consultant got a hold of them. They filed the claim for refund, but they never actually told the taxpayer that they had to go back and amend their their tax returns, whether it was individual, corporate, whatever. And so quite often the CPA or EA would find out about this, potentially not until they actually got the refund. So those cases also are out there. And so the problem is they didn't immediately file an amended return to pay the tax. And clients really didn't want to do that because they didn't have any money right now. And we didn't know how much of that claim would be paid to them. So they all said, we're going to, everybody started waiting till they got the refund. Of course, this backed up insanely at the IRS offices. Then there was all the reports of the abusive things, in which we all saw. So that slowed the IRS up even more. And so what invariably happened was people ended up filing these, filing claims, amending a 2020 return, let's say essentially 2 or 3 years after 2020. And it would report tax due. And the question becomes, does the taxpayer owe interest on that tax? This case, the Maddow versus Commissioner, Tax Memorandum 2026-60, deals with that question, right? So they had employee retention credit funds received by their businesses in late 2023. Now, this triggers clawback of qualified wage reductions, right? You are required, basically 2023, they've now underpaid their income taxes for 23 because they couldn't deduct the ERC credit that they received, that they were eligible for. So this required the shareholders of this S corporation to file amended returns and pay back taxes. Maybe required's a bit strong, but we really didn't know what was going to happen if you didn't. And it could be returning the ERC. I don't think they could do that, but it's possible. Could be a change of accounting. There's all kinds of ways the IRS could have played with this. And at the time that the taxpayer here got this particular, situation going and filed their amendments, IRS had not yet put out their statement saying, it's okay, just report as income in the year you receive it, which would, of course, have gotten rid of this entirely. This space, but of course that wasn't there, and people filed these. People before the IRS finally, after we got basically past the statute for being able to file a claim, finally gave us guidance in 24 about just pick it up in the year received. Well, unfortunately, here they'd gone back and amended 23. Right. So the IRS assessed automatic underpayment interest from the original due date of 23 return. So even though they just got their refund, right? And even though they filed an amended return immediately and paid the tax due on that, IRS says you owe us interest. Taxpayer says, hey guys, this isn't fair. Unfortunately for the taxpayers, first rule, fairness has nothing to do with how the tax law works. Second rule is mechanically, yes, you owe interest on that. So David and Krista filed a timely 2020 Form 1040. They report S corporation income from two corporations for which they got these refunds, right? And of course, they claimed the full deduction for all wages paid. Now, in 2023, they filed an amended 1040X, and they paid $37,546 in additional tax, representing the tax due on the wages that they had, basically on the wages they shouldn't have deducted, because they got paid a larger ERC refund under those rules. So they went ahead and they paid that tax. The IRS is assessing $5,438 now in underpayment interest for the 2020 tax year. Now, before anybody goes too far on this, yes, I kind of understand that we have that other Weplo case issue. We're not going to talk about Weplo here and how maybe that interest shouldn't have been assessed, at least until, beginning in July of 2023, but still, whatever. We've got that. So they might have a way to get it back, but it's a different problem. Okay. So the S corporation clawbacks force a retroactive individual Form 1040X. By the way, it's also probably true that, yes, all things considered, it would have been not a bad idea to have, if they were aware of the problem, to have argued that even if the interest was due, in essence, the interest didn't start accruing until July of 23, and that would probably wipe out a huge chunk of this. But still, we're there. And whether it's going to be worth it to raise the issue again is another problem. Now, the S corporations received ERC funds in late 2023. Because of that, the taxpayers filed amended corporate returns to reduce the wage deductions. That increased the S corporation net income allocated to the shareholders, right? So they filed a 1040. They're doing everything, right? They're doing everything to properly report their income. They filed the amended return for 2020, increased the income, paid the tax of over $37,000. They believe no interest should accrue prior to the 2023 amendment because, they said, hey, we're there. Now, I would now modify that to say that based on if Weplo decides what I'm hoping it decides, that really interest only been due beginning on July 10th. That's the alternative one. In any event, they didn't argue that, so ignore that for right now. Now, the IRS interest assessment. The IRS assessed $5,438 in underpayment interest, right? The interest was calculated from the original filing date of the 2020 return. This is where Weplo comes into play, or Quang, because the original filing date of the 2020 return was actually, in 2023, right? So the taxpayers sought abatements under Section 6404E1. They're trying to get it abated, saying this is not fair. The problem is that section's not set up at all to handle this request, right? So let's talk about Section 6404E1 of the code, right? That abatement excludes decisions related to federal tax law. Under 6404E1, the IRS may abate interest on underpayments attributable to error or delay by IRS employee. But the error or delay must be in performing a ministerial or managerial act. Here's your problem. And we review this for the standard review the court uses is for abuse discretion. Abuses exist if the denial is based on erroneous view of law. So in theory, since the IRS said this didn't apply, you could have held this was an erroneous view of law and the tax court could have overridden it. But the problem is it's not really. Treasury Reg Section 301 6404-2B states, any decision determining the proper application of federal tax law is not ministerial or managerial. And the problem was that they were waiting on the IRS to determine if they get a refund. That can't be counted as part of this. The delay was they could have filed their amended return earlier. They could have paid the tax earlier. Okay. They could have, and if you didn't want to pay the interest, this would have been the out, have paid the tax, right, back in 23. Mm-hmm. And, gone ahead and done that so that that's covered. Filed a claim for refund, right? Basically, saying a protective one stating, pending your resolution of the refund number here, we're asking for the entire amount we gave back. Obviously, if you pay us what we asked for, we won't get any, we're not going to ask for any of it back. It'll close out. So the abatement covers the abatement never covers legal interpretations or guidance application. The IRS was attempting to apply federal tax law and was even to an effectively unrelated. Does the IRS owe them money? Right? Not do they owe the IRS money? Right? And reasonable cause is never a valid basis for abating interest under the statute. The problem is under the law, this gem of a law Congress put together, retroactively, they owed this tax if they took advantage of the retroactive qualification for the ERC. Congress could have written law to have clarified that, yeah, that's not the case, to have also clarified that, that in essence, the taxpayer would need to file the amended return immediately after, the amounts there. They could have said we included it in the year we received the refund. They could have done all kinds of things to handle this. They did none of them. Yes, this is a failure of the United States Congress. Yes. And why I do that is because Congress people always act as if the IRS has nothing to do with it. As the Internal Revenue Code says, has nothing to do with it. No, the IRS doesn't get to write federal tax law. The IRS didn't write the CARES Act. The IRS didn't amend the CARES Act. The gang on the Hill did. And to borrow a line from Sergio Mendez, that's the fool on the hill, or fools on the hill, for all it's worth. Okay, I won't be on the Congress critters, list for gifts this year when Christmas comes around. So bottom line, there is no reasonable cause effect, basis for getting out of paying interest. Interest is pretty much a given. You owed the tax back in 2020. You didn't pay it till 2023. You owe interest on using that money for that time frame. Now, in this case, right, this is the underpayment interest accrues automatically from May 18th, 2021 return date. I don't know, 2021 49, I know 2021 20. Qualified wage reduction occurs in the year the wages were paid and accrued. And the court didn't find that was contrary to how the law is written because it frankly isn't. The law says reduce the wages in that year. Reduction does not occur in the year the ERC funds were received. See, the funny part about this is the tax court is essentially here saying that the IRS's, quote, relief is frankly not allowed under the law. But the IRS is never going to go after you for it. Okay. But the taxpayers paid their wages in 2020. Therefore, 2020 income must be increased retroactively. Right? Interest began to accrue automatically on May 18, 2021, the day after 2020 return due date. Remember, we got a temporary extension in 2020, for 2020 returns to file our returns. Well, yeah, and yes, it was for May 18th. Now, yes, I know per Kwong, it really was still, it was really already extended, and May 18th, it would be an irrelevant date if Kwong is correct. But nevertheless, interest accrual is a matter of mathematical operation of the code, and IRS officers do not abuse discretion if they follow the code. But here's what the taxpayer, yeah, but we called the IRS and we were told there'd be no interest charged on this, right? They said they were verbally assured by an IRS telephone agent that no interest would be assessed on 2020. The court accepted. They said, you know, I'm not saying they didn't tell you that. They very well could have. It wasn't the right answer. And the problem is these verbal assurances are legally non-binding on the IRS. Right? And so advice regarding the applicability of the underpayment interest is legal interpretation, and such advice does not constitute that ministerial or magisterial act under 6404E1. Therefore, erroneous oral advice cannot serve as a basis for interest abatement. Erroneous oral advice only goes ahead and solves your problem if you can get out of the item, normally penalties, for reasonable cause. Had this been a penalty, and IRS had advised them, orally that whatever they did wouldn't cause a penalty, and it does, and the person on the phone was wrong, if that penalty allows for reasonable cause, we could have gotten out of the penalty. But interest isn't a penalty, and therefore we can't get out of it with this. Okay. So some of our key takeaways, right? First thing is, remember, interest is special. It is an automatic mathematical computation. It's in the statute. The tax court will say every time they can't override a statute, no matter how unfair it might be, unless Congress allows them to override it. Considering the next case coming up is going to be an innocent spouse relief case, there's a cases where we can override the law, but we don't have that here for the interest. It's a simple mathematical computation, and no IRS discretion exists in standard computation. Remember, the only provision that can delay this is if the IRS administratively, excessively delays, the action in the case. But that wasn't the case here. There was no administrative delay that caused interest to run while the IRS, went out, was trying to compute it excessively. Oral advice. This is important. Clients' phone conversations with anybody from the IRS are non-binding, and at best are going to maybe allow you to get out of a penalty, but not interest. Only written advice under specific rules really offer potential relief, and even that won't for this. And the financial impact of the employee retention credit. When you evaluate the net benefit of the ERC, the firms should have budgeted for that underpayment interest. And that clawback interest will reduce the net cash flow from the ERC. You got interest on the ERC as well, but you've got to understand that's going to be there. If I do expect we're going to see some upset clients if the CPA or EA didn't advise them that holding off and filing the amendment later, was going to cause them to pay interest. Now, you and I know this is like a present value of money thing, right? So, hey, they're not really that bad off. But the problem is, aside from accountants, actuaries, and engineers, a lot of people have no clue what present value of money means, right? Accountants, actuaries, people in finance, it's not exactly something your average person will understand. You'll just get a blank stare. Start talking about present value of money in most cases. And that's true even of judges. So, not tax court judges, but judges, standard, average, county court judge. I think the stats indicate, about 3/4 of them really don't get this whole bit about, present value. 1/4 do. And if you win an award, you don't want to be in that person's court, I guess is what we'll say. Or if you basically, if you let's say, not if you win, if somebody awards damages, you don't want to be in that person's court. Maybe various things for whatever discounts are there. But if you're a CPA, you like that somebody understands present value of money. If there was interest that was charged to the client, so they'd say, well, yeah, you paid tax, you had to pay interest on that tax, but you got used to the money, so we have to give you some credit for that. That's not going to work with about three, just roughly from what I've heard, informally from attorneys. Yeah, they guess about 3/4 of cases that's not going to fly with the judge. You're going to be in trouble on that if they're going to award the interest against you too. Just that's a reason. There's a reasonable chance of that. Next, we're going to get an innocent spouse case because we haven't talked about one of those again. This is Anderson versus Commissioner. This is a summary opinion 2026-6. Now, remember, there is an issue when a couple files a joint return, right? Under section 6013, subsection D3 of the code, you sign a joint return with your spouse. Each of you is jointly and severally liable. And what that means is that the IRS can collect the tax due, assuming there's tax due and unpaid on that return. They can collect that from either of the two spouses. And that's true even if you get a divorce and the county court says, yes, Harry will pay any taxes due. Harry will pay any additional taxes assessed. That's not binding on the IRS. IRS was not a party to your divorce. IRS is not bound by that decision. Rather, if we're going to get out of that, we're going to have to find a way out through the innocent spouse rules, right? And this is found in section 6015 of the code. It's a statutory escape hatch if you're eligible to qualify for it, if you're an eligible spouse. Now, Tricia D. Anderson sought relief from joint liability following divorce. And the special trial judge in this case, Layden, granted her complete relief from joint deficiency in this case, saying that 6015 gave her the get out of jail free card. Because there was a significant amount of tax due from her and her, the return filed by her and her former husband for a year they were married. So they filed a joint return for the year 2016. Now, she was divorced from Quentin Anderson in August of 2021. Her Form 8857 request for joint, innocent spouse relief was timely filed in April of 2023. And the 16 return had a deficiency imposed because the IRS disallowed a mortgage interest deduction of $108,220 that was shown on that Form 1040, Schedule A. So, question becomes, does she owe the tax? Can the IRS collect the tax from her in whole or in part? Or under innocent spouse rules, are they going to have to go get the money from Quentin? Now, in innocent spouse cases, by the way, generally, although it does not appear he did so in this case, the other spouse can challenge this because obviously, if she doesn't have to pay any of it, then Quentin owes all of it as a matter of law. And that obviously is a big impact on Quentin. Okay. That's the back and forth. So let's see. The Andersons were married in 1991. They separated in 2016. That's what led to the sale of a house, etc. Mr. Anderson had earned all the income in the marriage, and he prepared and he filed returns. He had an MBA and he was an accountant. Tricia was a stay-at-home mother. She had a degree in psychology. She's not trained financially. We've got an accountant here who supposedly should understand the taxes better, we would presume. And we have a psychologist, somebody who had a degree in psychology, which last time I checked, if you're a psych major, you're not allowed to take, I should say not allowed, you're not required to take any courses on accounting or federal taxation. So presumably, Mr. Anderson knew more about this than she did. We're going to start with that. Now we have a home sale out of their revocable living trust, right? The mortgages listed Quentin as the sole borrower. And Quentin claimed $108,220,000 interest deduction on the Schedule A, the joint Schedule A they filed. Now, they were audited, and the IRS disallowed the deduction because Quentin failed to provide substantiation. He basically ignored the audit, fundamentally, because they actually paid this amount. Now, we can get into the question about whether it was all deductible, and whether it was over the $1 million and acquisition debt and all those things, but let's not deal with that. He just never provided any substantiation. The notice of substantiation was sent only to Quentin's address, and Tricia never received a copy of it. So the 9-day letter never went to her. The final settlement on the sale of the home showed that amount of interest was truly paid. Okay, so the amount was paid. Quentin on exam failed to provide substantiation, but on the document she did see, she knew it had been paid. It had been paid. There's no question. Can she get out of this tax? Now, the tax court possesses proper jurisdiction over standalone petitions under Section 6015 E1, subsection E1 Cap A. That is, a petition solely for innocent spouse relief. Now, as heard under a small tax case under Section 7453, that means this decision is non-renewable. IRS cannot take this case up to the Court of Appeals, neither could she had she lost, and it is non-precedential. This is important. While this case provides us with information about how a tax court judge looked at this matter and worked with it, it's not in theory binding on anything else at all. We get a whole issue. I remember when I first started in practice, we were told, tax court cases, published tax court cases are binding, but TC memos aren't precedential, which is also quasi-true. But they're less not precedential than the summary opinion. Yeah, we'll get it. Tax court always quotes tax court memos. We see them left, right, everywhere. It just doesn't decide a specific piece of law, but it supposedly is following the settled law. So you'll see that. Now, the court applies a de novo standard of review. Okay, it just kind of takes a look at the whole thing from start. So the review scope was restricted to the administrative record and newly discovered or previously unavailable evidence. So what was available when she asked the IRS for this relief, which IRS said no to? And is there any newly discovered or previously unavailable evidence that was not there at the time she went to the IRS? Under Thomas v. Commissioner, this is a published tax court decision, 162 TC9, trial testimony is considered previously unavailable evidence. So she's allowed to give her testimony at trial. The petitioner abandoned her claim under 6015B and instead moved to 6015C. So let's talk about what C says in this case, right? Relief under 6015C is barred if the commissioner can prove the requesting spouse had actual knowledge of the item. The commissioner bears the burden of proof under Regulation 1.6015-3, subsection C2I, right? In this case, to show actual knowledge. And actual knowledge for this purpose is a rigorous standard. Merely that she had reason to know is not enough. You've got to show she knew of the item that led to the understatement. And the real question is, what was the item? You might think, as the IRS seemed to think when they reviewed this, it was the mortgage interest payment, and she knew about a mortgage interest payment. She knew it was a mortgage, they sold the house. She knew interest had been paid. She knew interest was on the Schedule A. But the court said, no, this problem is because of lack of substantiation, right? Under Treasury Reg 1.6015-3, subsection C2 little I cap B, knowledge means knowledge of facts making the item unallowable. What made the item unallowable was not that it was paid. It was paid, right? She knew the home sale, she knew the mortgages, but she also knew the interest per that closing was actually paid. To bar relief, Tricia had to know that Quentin, her ex, would fail to substantiate the deduction in a future audit. Which means you also kind of know there's a future audit, but that's a different thing. And he would totally screw up and not substantiate it. Okay, because that's really, the IRS right now disallowed the interest based solely on the fact that he never brought up the substantiation, even though it's clear the amount was paid, right? She had no such knowledge that he would screw up the exam. Therefore, the actual knowledge bar, falls apart. She wasn't aware of it. As such, 6015C allows the court to allocate the taxes on the return. So, Mr. Anderson, her ex's allocation was 100%. He was the sole borrower listed on the mortgage with Citibank and Wells Fargo. He earned all the household income in 2016. Now, even though they lived in California, as we recall, for this purpose, we ignore community property laws. So, he was the sole party legally liable for and responsible for paying the mortgages. And because under 6015A, we ignore community property laws when we do a 6015 analysis, This is all his income. Because her share, she wasn't listed as a borrower on the 1098s. She had no independent income or assets in 2016. Again, we're ignoring community property law here. Had no source of funds to make the payments. Again, ignoring community property law here. And would have had no legal basis or reason to claim the deduction on a separate return. Right? If she filed separate, then, that would have been the issue. It wouldn't have been something she would have claimed on a separate return. So basically, it's his, right? So this is an audit defense shield, especially in a case where it turns out the X kind of just didn't do things, and that's part of the reason why the X is the X, right? The requesting spouse is shielded when a valid deduction is disallowed solely due to the other spouse's audit non-cooperation, right? If the expense was paid, actual knowledge bar is practically inapplicable. I mean, she had to know he wouldn't comply with the IRS, right? And that would be part of it. Remember, she wasn't even told of the notice of deficiency. She didn't know about that initially. So she didn't have the ability ever to step in an exam and take care of this, right? The divorce decree limits for 6015C, that's important, right? We have to understand this. Divorce decree saying Mr. Anderson is responsible does not itself bind the IRS. Again, the IRS is not a party to your divorce. And it's a spouse leave under Section 6015 is the only way to escape that joint liability here. And what taxpayers got to do, they must document debt, liability, and cash flow for an allocation analysis under 6015 for the spouse. And separate debt structures do provide better protection for the taxpayer. Next up, we have something that came out of the AICPA's Professional Ethics Executive Committee. This is a revisions to tax services interpretation under ET section 1.295.160. This is applicable if you are a certified public accountant, because in most states, the AICPA Code of Conduct is either directly enforceable against you or is considered a very, very, very strong indication of what you should do. Now, the official release date was July 15th of 2026. It takes effect on July 15th of 2027. However, early implementation is permitted and probably firms should look at doing that. Now, here's the catch. Even in a state like Arizona, where we don't really follow the code, we follow the code as a fixed date in the past, code of conduct, and gets rolled forward every so often. You still have to realize in a civil case against you, which is where the big risk is going to be here, because somebody's going to be suing you, not in federal court, to try to take your CPA certificate. They're going to be suing you in probably a state court for saying that, you weren't independent. And because you weren't independent, as under what we as the parties relying on the audit financial statements, have a right to think of independence. That lack of independence is, in essence, you therefore, the audit was wrong. It was an error. We relied upon it. We wouldn't have relied upon it had we known you weren't independent, which is probably iffy, but still, and therefore, please send us big check. So what this impacts is a CPA firm providing both tax services and attest services to the same client. Remember, independence is not required if all we are providing is tax services. And if you're an attorney listening to this who's not a CPA, or perhaps you're an EA listening to this, you may say, what do you mean? That's crazy. No, independence is a technical term if you are under the rules and the regulations applicable to CPAs, right? What you think of as independence is actually going to be incorporated into, basically other rules, right? So we're going to have other ways that we incorporate that. That means, because you think independence means that we are free from influence against our client. But see, the problem is an auditor is reporting on financial statements that their client is then going to take to a third party and claim that somebody who is totally independent of them, gave this, issued this clean opinion. So we need to be independent of the client. That's why in a pure tax engagement where I as a CPA am hired by somebody to just perform and do their 1040, no financial statements are involved, no attest services are involved. I'm not doing agreed upon procedure or anything else. I can ignore independence. I have to do what we call objectivity. Objectivity is closer to what you, if you're not a CPA, probably believe independence is. Objectivity. We are allowed, just like attorneys are allowed to advocate for the client, but you can't violate the law. So an attorney has to understand what the law is, because you can't just say ignore the law. But what you can do is you can take a look and interpret the law. And when I interpret the law and I tell a client about a position taken on a return, here's positions that I can sign the return on. Here's positions that you could claim legally under the law. Yeah, I can do those. Now, the problem is if you got an audited financial statement with a provision for income taxes on it, so let's say a C corp, that provision for income taxes, we have to say, is that fairly stated? And that's where we get to the weirdness of we're now not going to measure whether it's fairly stated as to whether it has reasonable basis and we disclose it on the return. Rather, we're now looking at it from the standpoint of a third party who's relying on that to believe that tax number fairly reflects what they're really going to owe. And as we all know, under the reasonable basis standard, we have no problem signing a return with disclosure or advising a client that this is a possible interpretation the courts might go with for this transaction. And if we advise them, as long as they do this on return, you should disclose it, we're allowed to do that. But having that undisclosed on a financial statement is a bigger problem. Because again, there may be a requirement to put it on a 1040 and disclose it on that 1040. But there's no requirement for me as a CPA to go out and tell anybody else if I'm just doing the tax work. However, if we've got an audited financial statement and I know there's an uncertain tax position, that's a different beast. So yeah, this is what gets weird. Now, the good news is most CPAs in public practice do not do attest services. And CPAs in industry are not involved in attest services. So this does apply to a minority of CPAs, but there are probably CPAs who are in larger, including larger local firms, where the firm does attest work. They do audits, reviews, agreed upon procedures and similar items. They need to be independent. This is going to make a big change for them. So firms have to update their quality control and independence policies by January 2027. The notice of revisions were published in the Journal of Accountancy online in July. So it's out there and you can go read it, right, as you do this. So what exactly happened here is, well, they unified definitions and they gave new rules to identify core independence threats from the performance of tax services. So paragraph 01 consolidates the definitions of tax services. It explicitly includes advising, planning, return preparation, and return transmittal as part of those tax services being provided. Remember, by default, under the independence rules applicable to CPAs who do need to meet those rules, those doing attest services, any non-attest service, in essence, puts your independence at risk absent doing certain special cases. Well, this identifies tax items that are going to be considered under the special rules for taxes. Paragraph 02 of the section explicitly flags self-review, right? Now, this is section ET.295.160. Paragraph 02 says this is a self-review, management participation, and advocacy threat to independence. Self-review because your firm prepared the tax return. Management participation because there are various decisions that are made on the return for elections and things like that. Quite often, the client's going to say, "I didn't know. Harry just said do that." Why did you choose to use Section 179 here? Harry checked. Harry, why did we do that? Just trying to immediately ask the CPA who handled the return. That's considering that you made management. They didn't make the decisions you did. And advocacy threats. Remember, we're trying to do an independent financial statement, but from a tax perspective, the last thing I want is there being tons of documents floating around telling everybody about how, about this potential attack vector for the IRS, because the IRS can discover those documents and we just outlined how to attack it. So we're not so thrilled with that. But these threats, which you need to consider with tax engagements, directly impact compliance with Independence Rule 1.200.001. So again, you need to explicitly consider self-review, management participation, advocacy threats if your firm is doing tax services as defined in its new interpretation. And you're also doing a service where you need to either disclose you're not independent, independent, non-independent compilation, or where you simply got to be not independent, like a review. Now, the old paragraph 02 defining tax return is relocated to paragraph 0.06a. This integrates the definition directly into the return preparation section. So that just moved it. You can go find it. Nothing happened there. Paragraph 03 restructures the framework for tax advisory and planning. It defined as advising an attest client on a structuring affairs in a tax efficient manner. That is considered to be tax advisory and planning as covered by this interpretation. You must meet ET section 1.295.040's general requirements for any such engagement. This is what also can get firms in trouble. The tax people only have an engagement letter for preparing return. They have an engagement letter for all the planning stuff, for a special planning engagement we took up during the year. So what are some specific examples of a tax advisory or planning engagement? Structuring domestic international affairs of the client, structuring transfer pricing arrangements. Structuring domestic international affairs includes entity selection type things, utilizing losses in a tax efficient manner, structuring capital distribution strategies, structuring senior executive compensation. You do a lot of that in closely held companies. Structuring exempt client to avoid losing status. Yeah, I got a 501c3 I'm working with a 990. We're going to be talking about and looking at, issues about what they have to do to keep their status, and structuring investments for tax incentives. So you should have engagement letters covering those matters, and they need to qualify under the general rules for 1.295.040, which generally requires that the taxpayer take specific responsibility for all decisions there, and there be a specific person appointed who is the client, with the client in a high enough level, who understands enough to make these decisions. They don't have to know how to do the thing, but they have to know, they have to be able to explain rationally why we chose to do X, not Y. Okay. Now you got to document 4 evaluation factors for independence risks, right? Paragraph 04 mandates application conceptual framework for independence. ET section 1.210.010. You must evaluate and document significant of identified threat. So what are 4 evaluation factors? Confidence level that the output is supported by the law. Whatever we did, there is legal support for this. Whatever output is based on established practice. We're doing it properly. Assumption of, if there's any assumption of specific review by the taxing authorities of what we're doing here. And is significant of the tax services to the attest subject matter. Immaterial may make it much less relevant. And examples of safeguards are found in paragraph 05. You apply safeguards if threats are unacceptable. In examples, using non-attest team professionals, independent reviewer, independent from the tax team who's not involved with the client, and getting pre-clearance from tax authorities. If the tax authorities review and pre-clear, that's only on a larger entity, but there's a lot of that done, and that obviously is a way to, help eliminate and safeguard some of the independence risks. Paragraph 06 redefines return preparation and custody boundaries. Paragraph 6, drafting, compiling information, including tax due on standard forms, are part of preparation. That includes estimated tax vouchers, extension forms, Forms 990, 5500, 1099, and W-2. It's more than 1040, 1120, 1120S, 1065. It also includes advising on past transactions and responding to taxing authority inquiries. Custody and control examples. Paragraph 08, which is a bullet to the list. What is not custody or control over client funds? That is a concern because we're not supposed to have that to be independent. It's not custody and control over client funds if you're making authorized electronic payments pursuant to prescribed criteria. So putting the client's bank account information, that they've authorized onto the return that will then take the money out of the account and put it in, pay it to the IRS. That's not going to blow the independence. That's considered to be not custody or control for that purpose. Affixing depository account info on the tax return. telling them where to make the direct deposit for your refund, and remitting client check payable to taxing authority. You're not allowed ever to cash the refund checks, but if you want, please don't. But if you want, and you take the check from the client, and you agree to mail that check to the IRS, that's not custody of client funds. That's specifically exempted. And Form 8879 updates strict electronic signing preferences, right? This is under paragraph 09 of the AICPA's new ethics interpretation 1.295.160, which is formerly paragraph 04. Those are rules for signing and filing on behalf of management. Electronic procedures must meet the standards for electronic return originators. Okay, you got to do that. You must follow the Form 8879 or 8453 officer rules when you're accepting those electronic filing authorizations. And some other key sections. Paragraph 10, representation of a client on exam is permitted if the client agrees prior to resolution. A power of attorney is a fine if it's limited to tax matters. That'd be a big issue if it wasn't, because you can't get a POA. Representation just went out the war. But representation in court strictly impairs independence. Now, the definition of court is simplified in this. You want to reread that. But basically, if you're going to be, let's say you qualify, you take the exam, you qualify to practice for the tax court. You cannot represent a test client before the tax court without the firm giving up the intest engagement. Right? That's going to be independent. This is strictly prohibited. So, yeah, we have a problem there. With that, we're now done for another week. Isn't this great? We're done. I want to thank you for going ahead and paying attention to this, watching or listening. My email address is there in the final slide, Zollars at currentfederaltaxdevelopments.com. Again, the slides are available at the currentfederaltaxdevelopments.com website. If copies of those slides are available and copies of the articles that describe these developments are available there. If you go to our weekly audio and video updates section there, you'll find this one. Once I get everything posted, it'll be there. I also do participate in the Connect groups for the following stateside CPAs: Arizona, Idaho, New Jersey, Illinois, Minnesota, and Washington. I also, will check email addresses. As I said, if you have some questions, you can try putting something there. Otherwise, we look forward to hopefully seeing you next week for another week of current federal tax developments. We'll see what Congress comes up with. Anything happens. I know already that we have another ERC case. Already got that in play. We've got the IRS reversing a reversal on a private letter ruling too. That's also I know is already in play. I finished up drafting this stuff on Friday, and by the end of Friday, those things had come in. So we're gonna have those for next week because we've been doing this long enough this week. So we'll see you next week here on Current Federal Tax Developments.